Okay, in this video we're going to learn how to journalize how to issue a bond, and we're going to start with the simple one where the contract rate is equal to the market rate. So it's being issued at face value. So remember, the contract rate is the rate on the value of the bond, and the market rate is the rate that we could get out there in the market. So when the contract rate is equal to the market rate, that means we're going to issue it at the face value, which is at 100%. So on January 1st, Cole Corporation issues a $1,000 6% 5-year bond that pays semi-annual interest. That means that this bond is going to pay interest every 6 months. So we need to journalize the entries to record the issuance of the bond, the first interest payment, and the payment of the bond at the maturity date. And the maturity date is the term of the bond. So that would be 5 years out from this date. Okay, so let's start at January 1st. So a company issues a bond because they want money. So we're going to get cash. So let's go ahead and debit cash first. Since we're issuing it at the face amount, we're getting $1,000 cash. And then we're going to set up our bonds payable, which is a liability account, saying that we're going to pay this bond back in 5 years, the face amount of $1,000. So this is our original entry. Cash goes up, bonds payable goes up. Okay, and then next, we're going to have our semi-annual interest payment in 6 months. So that would be June 30th. So when we make this payment, we always pay it on the face value of the bond. Okay, so to get our interest payment, our face value is $1,000. Our rate is 6%. And then the time, what you want to do here is, I always write it as a fraction. So you want to do every 6 months, they're going to get a payment out of 12. So if it was every 2 months, you would do 2 out divided by 12. Okay, so now we know the interest to be paid. When you multiply those three together, 6/12 is 0.5, but I'm going to write it like that. Your interest to be paid would be $30. If you want to make a note, whenever you're paying semi-annual interest, you're always going to write 6/12 or 1/2. So it's going to be interest expense 30, and then I'm going to pay them their $30, so I debit credit cash. And this is important because this is the reason why they lend us money, is because they expect those interest payments every 6 months. At the end of the term, in 5 years, when I go to repay this, so that would be January 1st, 5 years later, so I'm going to get rid of my bonds payable, the total amount. So I'm reducing my liability, and then I'm going to pay them back their cash. If you can really get down the journal entries for the face value, then you will be able to understand the extra element of premium and discount in the other 2 videos. So if you can really get a good understanding of the basic entries at face value, this will help you when you add the elements of a premium and a discount. So always start with this video and getting this down before you do the premium and the discount. So it's borrow the money, repay the interest, or pay the interest, and then repay the bond. And you might want to write that down. Borrow the money, pay the interest, repay the bond. Let me know if you have any questions.